I guess my feeling is that we're too close to the bust for anything like that, because that's going to take time. You just don't all of a sudden roll out. We're revaluing gold, and I'm not sure how we do that exactly. Anyway, it's not like we're in charge of that. So I'm skeptical of that. Certainly skeptical of it happening before a bust. By the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives the next cycle is going to be a commodity cycle, an inflation cycle, and I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
Precious metal markets are preparing for extraordinary volatility as financial liquidity shifts and global economic imbalances continue to build up quietly. Current market sentiment reflects deep skepticism, creating a classic wall of worry that paradoxically provides the necessary fuel for a massive bullish rally across key hard assets. David Hunter, a veteran contrarian macro strategist with over 50 years of financial market experience, emphasizes that precious metals are on the verge of incredible parabolic surges. He forecasts gold rising rapidly to $7,000 and silver reaching $200 during the current advance. Looking ahead toward the subsequent commodity-driven inflation cycle, he projects gold reaching an astonishing $20,000 per ounce, while silver surges to $1,000. While temporary retracements could occur, the underlying technical indicators suggest a historic upward move is already underway. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Just point out, before we go to gold, the IPO thing is a troubling sign because it's demanding a lot of capital that's got to come from somewhere.
Yep.
I mean, I have long argued that everybody would look and say, well, the Fed's, raising rates or money's not flowing right now. Where's the liquidity that's going to drive your bullish market forecast? And I said, the institutional investor has been skeptical from the bottom in 1982 all the way up. They first it was a bear market rally, then okay, it went to new highs. I guess we got to jump on a little bit, but they kept their, even now, most of them their targets are right near where we are. A few have raised them towards 8,000, but so there's been a wall of worry. There's been a skepticism. That means there is liquidity that can fuel this, but it does become concerning when you have a SpaceX that demands as much capital as that did, and there's other AI companies obviously coming behind them. So at some point, it does, the pot of money isn't infinite. So that can be another issue as we move towards this top. But we're not there yet. I just think there's enough signs that this thing has some legs. And I think that's what's holding this market back, is that kind of concern that, people have enough things out there that they can be bearish on if they want to. And certainly that question about liquidity is one of them. So gold, I'm equally bullish on gold and silver. We had that great run from November to January in silver, and gold was a longer run than that. But silver got up to 122 from it had been in the 50 area when it broke out. That was a long-term breakout point. There's 48 or 50. And it just took off and basically went parabolic, covered more than doubling in, probably 150% in 3 months. And so, people are, you had to correct what was, speculative blow off. People were just through the roof in bullishness, and you had to correct that. I thought it correct in a few months, but it's taken 5.5 months now, and you've gotten a lot of that speculation out of there. Certainly a lot of people who jumped in the last inning of that run, they weren't there at 50, they weren't there at 75, they might have gotten there over 100, and all of a sudden they're down in half almost, and so that wakes you up in a hurry and turns you bearish in a hurry. So I think we have the sentiment there now, the backdrop and sentiment there now, where we can come out of this. And I believe normally I'd say a parabolic usually comes at the end of a move, at the end of a big cycle move. But in this case, it was so fast and it unwound so fast that I think there's even a steeper move following that. So if you can do that in 3 months, you can see another. My target on gold is 7,000. My target on silver now is 200. So particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect. I realize there's lots of people out there in that field, people that follow gold and silver closely, who think they both have more to go. The breakout in silver was 50. Gold looks like it could go back 3,500. And so I can't say that's impossible, certainly, until this thing really gets turned around and you start seeing a little more upside. There's always a risk that, this is just another dead cat bounce and it goes lower. I think, based on what I see in sentiment and what I see in in the charts and everything, there's a pretty good chance we came down to a trend line on silver, and gold looks like 4,000 or 3,900 is a pretty good place. And ironically, and I didn't do it for this reason, but if my numbers, and my numbers may not be right, but if my numbers are right, 200 on silver to get back down to 50 would be about 75%, and it would be exactly 75%. That would be, kind of a normal in the, if I'm right about what equities are going to do and what we're heading for in terms of global bust. Silver is a very cyclical metal, and it will get hit almost as hard as equities. 75% would make sense to me. That would take you back to that 50 breakout point that all these technicians think is necessary to get going. So you could have it, but not have it now and have it later. Got down to 56 in this correction. Gold, from 7,000 to 3,500 is 50%. 50% retracement would be a very normal retracement in anything, but in gold, certainly that would make sense. So whether those numbers are right or not, I didn't get to my numbers that way, but the other day I just said, those are convenient, kind of places where it could correct from. So I think the possibility is that all those people waiting here for that last shoe to drop, as often the market doesn't accommodate, you take off from here and you get to those breakouts, those natural places where it should go down to in the bust rather than now. I guess my feeling is that we're too close to the bust for anything like that, because that's going to take time. You just don't all of a sudden roll out, we're revaluing gold, and I'm not sure how we do that exactly anyway. It's not like we're in charge of that. So I'm skeptical of that, certainly skeptical of it happening before a bust. I by the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives, the next cycle is going to be a commodity cycle, an inflation cycle. And I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
Okay.
So I'll top them, but just not now. It might be wealthy investors who are running to the safety of treasuries here, see a bargain, because I do think the bond market is bottoming. And it may be more a sign of how bearish they are about the stock market, which I keep arguing is that wall of worry that's going to keep it going here. So I don't know enough about it to know who the buyers are there, but it may not be the conspiracy everybody thinks it is. We are approaching a 3-year bottom in bonds. They fell, I think it was October of 2023. So we're that's the anniversary for the being along the bottom here. I think this is a major bottom from which we will see a major bull market in bonds, and obviously a drop in a rollover in rates. So I'm thinking, because the economy is slowing, And I was pretty alone out there saying I think inflation, the trend in inflation is still down. That sometime in the next few months we'll see the trend reassert itself on the downside. Well, we got that this week with the CPI and PPI, and I think the New York Fed president this morning in comments in a speech he had said it's possible we may have seen the peak in inflation back in May or June, and that we are rolling over. So, and I agree with that.
Central bank policy lags ensure that monetary authorities will inevitably misstep when attempting to manage systemic economic stress. Initial reluctance to inject liquidity will conflict sharply with the heavy leverage embedded across private credit and equity markets. Once credit delinquencies surpass critical safety thresholds, central banks will be forced into aggressive intervention. This rescue response could unleash $20 trillion in new money creation from the Federal Reserve and up to $50 trillion globally. With a typical monetary lag, this massive liquidity injection will trigger extreme inflation, expected to surge to 25% by the early 2030s. Driven by inflation expectations, long-term interest rates and consumer mortgage rates will skyrocket into high double digits, creating severe affordability constraints across real estate markets. Now, let's get back to the interview.
Money will be coming in big. I'm talking about the Fed maybe going to 20 trillion in new money. They obviously did 5 trillion in 2020, 2021. But I think this time, because of the leverage and because of what I think will come as a result of that, it may take 20 trillion out of the Fed and who knows, maybe 50 trillion globally out of the central banks to turn things. And that will, with a lag, Kevin Warsh is right, with a lag, you will see inflation, and inflation like we haven't seen in this country even back in the early 80s. I think you could see by the end of, or probably by the early 2030s sometime, maybe 2032 or 3, you could see 25% inflation. And obviously interest rates follow inflation, so rates would be certainly high double digit. Mortgage rates would be in that place too. And there's just no way you can afford housing at those kind of rates. I think he's great. I think he's almost made for that job. I'm basically a monetarist myself. I do think he understands that over time, not short term, but over time, money printing leads to inflation. And if you allow inflation in your country, then you're gonna have all kinds of problems. So I think he has the right mindset. He's a long-term thinker. He's not trying to call rates between each meeting. I like his idea that we should be doing less talking as a Fed. It got out of hand, not just under Powell, under Bernanke, under Yellen, and before that, maybe some under Bernanke, where it was like they were almost rock stars. They wanted to see themselves out there making their pronouncements about what they think the next rate move is. And years ago when I was following the Fed, we just didn't see that. Certainly under Greenspan, we didn't see that. And even before that, it was the Fed was in the background. They weren't up front and center and on TV all the time. And Kevin Warsh is an inflation fighter, and he's somebody that really understands you lower rates prematurely and you're going to have higher rates, not lower rates. If you ease too soon, you're going to have inflation problems and rates will follow. So he understands more than anybody else, I think, that, and I've always said this, markets determine rates, not the Fed. So yeah, the Fed can control the overnight money rate, but it doesn't control where rates go longer term. And so it's kind of, again, Trump's a real estate guy and he always wants lower rates, but the Fed's not in control of that. And we saw that obviously a couple of years ago when they cut rates in August, I think, or July or August prior to the election. And, long rates went the other way. So I think Kevin Warsh is his own man. I think people somewhat misunderstand. Trump was more upset, I think, with some other things that went on. with Powell that made him feel like he's just another TDS guy, whether he's right or wrong. I defended Powell a lot through those years, even though I do think Trump has been under the gun from a lot of people. I did defend Powell in saying, basically, if you look at the Fed, how can you fault them? They've brought rates down and kept the economy going, or they brought inflation down and kept the economy going through most of his time. The Fed was more right in what they were doing. They were getting criticized for not fighting inflation enough or not easing enough, and yet in the end they had it kind of just right.
Following the anticipated peak in precious metals, financial markets will face severe post-rally retracements occurring alongside a global economic bust. Because silver operates as a highly cyclical metal, it is expected to undergo a steep 75% decline from its $200 high, bringing prices back down to test the critical $50 breakout level. Concurrently, gold is projected to experience a standard 50% retracement, pulling back from its peak of $7,000 per ounce to around $3,500. These dramatic drawdowns will coincide with widespread liquidation across equity markets as accumulated private credit leverage unwinds. Crucially, global financial markets rather than Federal Reserve benchmark adjustments will determine long-term borrowing costs. Even when central banks lower short-term rates, bond market forces can push long-term yields in the opposite direction due to underlying macro pressures. Navigating these severe swings requires understanding that parabolic advances inevitably lead to deep structural corrections before the subsequent long-term commodity cycle takes hold. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.